This is the current federal tax developments for the week of July the 7th, 2025. Current federal tax developments are brought to you by your state society of CPAs. This week, we're going to take a look at some things that happened during the week in tax and probably briefly discuss, or at least right now, something that happened that we clearly don't have time to go into in depth. But in case you were not aware, on July 3rd, the House passed the One Big Beautiful Bill Act, the version identical then to the one the Senate had passed as a substitute to the earlier House bill, thus allowing the bill to move on to the president, who, as I record this on July 4th, is probably, according to what reports have been given, likely in about 3 hours to have signed the bill into law. Thus, we will have a brand new bill probably by the time you hear this. It should be in law. Okay, maybe there'll be a curve thrown at it. Maybe they'll find something in the bill that just like, oh, we can't sign it now, it's got to go back. But it seems unlikely. So probably we have a brand new bill. Now, we can discuss later, perhaps take a look as we see more details and guidance come out, what's in the bill. Certainly over the next few weeks, you're going to see a lot of articles written, a lot of documents put out regarding items in the bill. So we'll see what comes up in terms of guidance. I will just warn you right now that the bill is out. I was able to get the the engrossed Senate amendment, which is the bill that finally passed, from the congress.gov site for HR 1 for this session of Congress. So the actual text is available if you want to go read it. And I'm going to be doing a few courses for a few state societies. That will be 2 hours or potentially a couple of longer ones that'll go into what's in the bill. But definitely, though, 2 hours is going to be enough fun to get the whole thing in or try to get significant parts in. So not really what we're covering here with this weekly update. So we'll just let you know, though, there is that bill. So if you hadn't heard about it, yeah, you have some work to do in terms of catching up on tax law changes. You might want to consult with your tax service and make sure you understand what exactly happened, especially as it impacts your clients. With that, what we're going to talk about this week, though, are a few developments, one of which will be a case related to the Anaheim Mighty Ducks, basically their ownership and the related company that's managing the arena they're in. This would be a bad debt deduction. What is a bad debt deduction, as well as how one could escape an actually related penalty. This comes from the case of Anaheim Arena Management LLC versus Commissioner. We'll also discuss a notice that the Office of Professional Responsibility sent out by email this week, discussing FBAR compliance and your due diligence requirements under Circular 230. We'll take a look as well as a partnership audit rules under JM Assets LP versus Commissioner. This is going to be a statute of limitations issue under the Bipartisan Budget Act, where the U.S. Tax Court, relying upon Loper Bright, is going to hold that the IRS regulations interpreting the BBA on one issue are outside the law. And we'll talk a little bit about what they ruled, what the issues are, and how that could impact you. We'll also talk about a penalty assessment issue that arose under the TEFRA partnership rules. This is the case of Moxon Corporation versus Commissioner. This case will be an IRS win when the court held that for purposes of the TEFRA partnership rules, partnership examination rules, that the penalty applied at the partnership level is not subject to deficiency procedures. And you can actually have the fact that even though deficiency is barred, the IRS can't collect it because it is barred by the statute of limitations, they can still collect the penalty that would have applied to that deficiency. So it's a really interesting, weird case. And then finally, we're going to take a look at a case of the accountant who just really didn't make a good impression on the court. They didn't find her plausible in the case of Beleiu versus Commissioner. This is upholding civil fraud penalties against an accountant and financial analyst who was taking care of the bookkeeping and preparing the tax returns kind of on the side because she was a full-time financial analyst pulling down some pretty big money. But she took care of this on the side for her husband's business. It wasn't generating that much income, but it was generating more income than she reported on the return. So we'll talk a little bit about that. So let's talk about the bad debt deduction issues that came involved in the Anaheim Arena Management case, LLC versus Commissioner, and also why, in this case, the partnership did not get hit with accuracy-related penalties, even though the court clearly held that there was no bad debt. Now, the citation of this case is the Anaheim Arena Management LLC versus Commissioner, Tax Court Memorandum Decision 2025-68. Decision was issued on June 30th of 2025. Now, this case provides some insights into the distinction between bona fide debt and equity for tax purposes. That's especially true with related party transactions. And, bona fide debt becomes significant because you can't have a bad debt deduction if there is no actual debt in play. And this case also clarifies how you can use a reasonable cause defense to get out of many accuracy-related penalties, because this taxpayer it is a perfect illustration of the reliance upon professional advice and exactly how you have to dot the I's, cross the T's to make that work. But they did escape the penalties entirely, even though they didn't escape the tax. So let's take a look at the overview of this case. So what are the facts in Anaheim Arena Management case? Well, Anaheim Arena Management LLC was a partnership that managed a Honda Center in Anaheim under an agreement with the city of Anaheim. Now, this is a related party to the group that owns the Anaheim Mighty Ducks of the NHL. Now, the management agreement dictated that all funds received related to operations were the property of the city, even was held by the partnership. Now, the partnership was required to make operating loans and debt service loans if essentially there wasn't enough cash to pay the expenses of the Honda Center. And AAM also made capital expenditure loans as part of this particular structure. Okay. Now, these advances were documented with promissory notes between AAM, Anaheim Arena Management, and quote-unquote the Honda Center. One problem with the note is it was a note between an entity, the LLC, and a building. Now, problem is buildings don't have capacities to enter into contracts. They also don't have debts. They are a physical asset. They are not a legal entity. They are not a person. So the problem was there was no way to enforce a debt against the Honda Center, the building, right? However, under their agreement, repayment of any of these advances was to come solely from Honda Center revenues. The city did not pledge their full faith and credit to get these advances repaid. If there was not sufficient revenues under the really weird waterfall structure that these revenues went through as to where they went, then AAM and its affiliates just had to eat the amounts they were putting in, right? So now AAM did have a right to a significant share of residual profits. After all the cash flows were done, all the money went where it needed to go, AAM got 100% of the excess money, up to $12 million each year, and then 75% thereafter. So essentially, if it made money, they got to keep most of the money. Okay. In 2015, AAM CFO concluded these advances, which were piling up, were likely never to be repaid. And that led to a claimed loss for bad debts of $51,465,228 on the partnership's return. As you might guess, that got the IRS's attention. Now, let's talk about what's needed for a bad debt deduction. This is found in Section 166A1. A key requirement is there must be a bona fide debt. That is, a debtor-credit relationship based on a valid and enforceable obligation to pay a fixed or returnable sum. This particular case, because you might guess a case from Anaheim would go to the Ninth Circuit on appeal. So because of that, the court looked at the Ninth Circuit's 11-factor test to determine, is this advance debt or is it equity? Now, as the Ninth Circuit has made clear, and as often is true in these like 11 factors type tests that have a whole ton of factors, no single factor is absolutely determinative. Rather, it's a focus on the economic substance of what's going on. These help you determine the economic substance. So they look at the names applied to certificates, the presence or absence of maturity dates on the obligations, where the payments are coming from. Is there a right to enforce payment of the debt? Does the creditor participate in management of the entity? Right? What was the overall intent of the parties, really? Is there thin or adequate, or is capitalization thin, or was it adequate for the party to which you're loaning the money? Right? If you're loaning money to a party that never could repay it, it's not really a debt. Right? It's like there's not enough there, not enough money would be put in, you're kind of in trouble. Is there an identity of interest on both sides of the transaction? Is the payment of interest only from quote unquote dividend money, what would be earnings of the entity? And could you obtain outside loans on similar terms? Those are the key factors. Now, on the actually related penalty, 6662A applies to substantial understatements or negligence. Now, this is going to be obviously a substantial underpayment penalty. We're going to go way past the $5,000 and past the 10% for the partners in question. So, I mean, it's a pretty big deduction, so we're good. But you also could look at negligence. But in either case, you can get out of the penalty if you show under 6664C1, even if the IRS carries its initial burden, if you can show good faith reliance on advice from a competent, independent professional, that will get you a reasonable cause, good faith defense against having to pay the penalty. Finally, there was a question about supervisory approval. That's come up in every penalty case now you pretty much see. Under 6751B1, the IRS must have written supervisory approval for an initial penalty determination on an exam. Now, what's an initial penalty determination varies from circuit to circuit. So unfortunately, I can't give you a nice, simple decision. Ninth Circuit is pretty much so long as, approval is given before the point at which, the IRS has formally locked down, right? Issued the notice of deficiency, it's early enough. Other circuits will treat it as much earlier. So, looking at that debt versus equity requirement, the court systematically applied these factors, and it found none of them indicate the advances were debt. Number one, Honda Center was not a legal entity, right? The notes were unenforceable outside the management agreement. The maturity dates, while on the notes, were routinely extended. The advances were effectively, despite having maturity dates, treated as simply a revolving credit line. They noted that repayments were expressly limited to highly uncertain Honda Center revenues. That's the reason why we have bad debts, or claim bad debts here. Advances were integral to the management duty of AAM, and profit sharing, in the rights to profit sharing, these aren't traditional loans. It's more of an equity issue. AAM's overall return included residual profits, so it's basically an equity investor in this non-entity center with the city. The Honda Center was inadequately capitalized. In essence, right, the city didn't have a separate set-aside thing called the Honda Center that had funds in it. There was really nothing coming from the other partner in terms of that would have given you any basis for the debt. In essence, you're loaning money to an entity whose only real equity or cash as you have it is coming from you. That's not much of a that's not really a loan thing when you're one of the owners and you're putting money in, right? Not really going to work. A third-party lender would never have made these advances on similar terms. You will be laughed out of the building if you go to a lender or tried to sell bonds that had these terms. You would be laughed out. No rational person would enter into them, right? Basically, that's the hitch. So, no question, the bad debt deduction was disallowed. The debt was not real. However, the court did not agree with the IRS that the accuracy-related penalties should apply. Now, they did say that supervisory approval was satisfied, so the assessment of the penalty was fine. It didn't violate the supervisory approval problem, but AAM had reasonable cause and acted in good faith. Schulman, the AAM officer, reasonably relied on competent CPAs, Beleiu and Beleiu, who implicitly determined the advances were debt, even though their written memo focused on whether they were worthless. That was kind of the IRS's complaint. They were saying, hey, wait. This memo just talks about whether they're worthless. The attack here isn't that they're worthless. The attack here is they're not debt. And what was really important in this case is that the two CPAs both testified at the tax court trial that they had implicitly concluded that the debts were, that these things were debts. And they had been provided with all information by Schulman, to come to their conclusion that he could, that the entity could claim this $55 million loss. So essentially, the court ruled in favor of the commissioner on dishonest bad debt. Advances weren't bona fide debt, but in favor of AAM on the actually related penalty. They had reasonable cause, and they had good faith reliance. They didn't go opinion shopping, right? They just went to a CPA that they felt, CPAs that had the apparent ability to give advice on this issue. They gave them all relevant data, and they followed their advice. Now, what doesn't work, as I said, is if we discovered that you went to 35 different CPAs or CPA firms across the country, and the first 34 said you're crazy, no way you can do this, and one finally said yes, that wouldn't be good faith. You weren't really seeking out advice and following it. You were just going to keep going till you found somebody who maybe was, let's say, not competent or whatever, but would give you this out in the middle of left field decision. That's not what they got here. They didn't do that. They weren't opinion shopping, and they actually followed the advice. So the court said, we're not going to penalize you for that. Now, some takeaways from this case. Number one, substance over form. That's really true with related party notes. Merely documenting your advances as loans and notes is not sufficient to save the day. Now, I will say failing to document them can be really problematical, but documenting them doesn't automatically mean it's good. Keep that in mind. In this case, the underlying contractual relationships and repayment terms just don't support a true debtor-creditor relationship. A key issue we always have to ask is this a real loan? And if you are in equity position, there's a chance they'll try to say it's equity. But if it's let's say a relative, some other party that you'd want to favor, they also may decide, that it was a gift or something of that sort. It's really important to show that when the transfer was made, there was an intent for that to be repaid by the other party. That's why I always get a little nervous when people start writing letters about, well, we're going to loan your kids, what is it? Let's say we're going to loan the kids $250,000, right, to whatever, buy a home, or down payment, which you're supposed to disclose if you did this loan, but that's a whole nother long discussion. We'll ignore that side of it. But I'm going to loan you the money, but what we're going to do is every year we're going to gift you the money to, so that for whatever you need to repay, we'll use our $16,000 or $17,000 each here in Arizona community property state, so we can use $34,000 if we're a married couple, and if we're loaning to our son and daughter-in-law or daughter-in-law and son-in-law, we could use another double up there, to get a lot going per year and just kind of waive it that way. That's not a good thing to say up front. I always get nervous when I see people give that advice. It's like, that would be bad because that shows no intent to repay. If there's not intent to repay, then we have a problem. So I always have a little concern with those. I'll just mention it because, gang, this is the test the courts use. I realize people do that all the time. Don't tell me, I don't need to, let me know that you do this all the time. But be aware that it does cause a problem of proving an intent to repay. Nobody ever intended it. It was intended to be a gift all along. That's not a good thing to have, that out there documented in writing. It's also not a good thing to say. That's kind of the problem, because parties, and what sometimes happens too is if the parties no longer get along, then in litigation it's going to come out, that there was this promise that I would never have to repay this. And yeah, that's the sort of thing the IRS can go to get those, get those documents from court, and just start using that as saying, hey, look, here's what happens. We have this testimony that you in essence said they never had to repay it, and and the court, let's say in Arizona, ruled, yep, they don't have to because they had the assurances they wouldn't need to. They say, well, pretty much that wasn't a loan. Tough luck. Related party transactions especially are subject to scrutiny, right? So in this case, it wasn't that in essence, it's not a relative here, but in this case, it was the fact that the lender had a significant operational profit-sharing stake in the entity in question. This is a big problem for loans to or from a closely held company. Again, you got to show there was legitimate intent to repay. I am very nervous when I see tax practitioners who regularly just throw everything into a due to from account. First thing is the open account debt rules. That's an S corporation. We got all kinds of potential issues that arise there. But secondly, in essence, you can't journal entry a debt because it has to have been the intent of the parties when they issued the check, to have it, be a loan and repaid. Not just that they grab the first available checkbook because all the money's mine. Yeah, that you can't journal entry fix that one. Bottom line. Contingent repayment, that is a problem. The prepayment was solely from uncertain project revenues, especially if you have no recourse against the other partners, is an equity rather than a debt advance. And that was what they found here. If you are going to take a position, though, while this did not execute correctly the debt was, the agreement just wasn't a debt. It did perfectly execute how you protect a taxpayer from penalties via professional advice. This is the perfect case. There, everything was done properly. This one was right on, right? You have thorough documentation of good faith reliance on competent professional advice. In this case, that's exactly what they did. This case was just perfectly on that point. This is how you defend yourself against penalties. And your client has to understand that if they're going to get penalty defenses, if a client just goes out and, oh, you won't tell me I can do this, well, I'm going to go out and find a CPA, EA, or attorney that will let me do this. Well, good luck with that, but you've just blown your chances of having any penalty protection. That letter won't be worth a cent unless you can sue the professional for, malpractice, because, and then they come after you because you didn't tell them about all these others. Yeah, it could be kind of messy that way. We'll phrase it like that. You really need to understand this rules. This is how you do it. This is how it works. And there was one thing that put this at risk, and that is if you are asked to rule on something like this, try to take care that you identify every issue that could be raised. The nature of this agreement was such that, it obviously whether or not it was debt was going to be a key issue. It's best to address that head on and come up with reasons why it's debt. Not just assume it's debt right away. Go ahead with that. Consider all possible attack points of the IRS. The fact they might even have an audited financial statement that calls it debt doesn't mean it's debt. right? In essence, the auditor is auditing under, different rules. And secondly, they might have got it wrong. You have a whole different area here. So make sure you consider that. Anytime we have related parties and we have something that's a debt, and it's going to be important that that be a debt, you really got to consider whether you can meet the bona fide test and consider the potential IRS tax on it. Next up, the Office of Professional Responsibility sent out a little email this week that talked about FBAR compliance and your due diligence requirements under Circular 230. Right. So this was an alert from the Office of Professional Responsibility, issue number 2025-10, issued on July 2nd with the title, Tax Practice Obligations and the Report of Foreign Bank and Financial Accounts. Now, the FBAR, FinCEN Report 114 for its official name, is a critical information report for identifying foreign financial accounts held by a taxpayer, right? It is a significant, significant focus of the IRS Office of Professional Responsibility, and their position is there are specific obligations on practitioners under Circular 230. I remember when Karen Hawkins was the director of the OPR, she made it very clear that there are very specific requirements that you should follow through on. And you really need to do this too, not just so much for OPR, because, we might wonder whether some later case law, really backs up OPR's position on this. But your client almost certainly will claim that if they get tripped up by FinCEN and not filing reports and they get penalized, the penalties aren't small, that they could say, well, I relied on you. It's a tax thing, right? It's kind of a quasi-tax thing. So that's kind of where we get into issues. And the fact that OPR has always said that you have a responsibility on it because it is on the 1040 Schedule B, ask about it specifically, and how in the world do you fill that out unless you had found information about should that be checked yes or no at the bottom down there. It's a problem. Now, of course, the purpose of FBAR was to identify individuals using foreign accounts to circumvent U.S. law, money laundering, etc., that kind of thing, or just conceal their income. The old offshore bank account issues, those things are why we have the FBAR requirement. Who must file is a United States person. That includes not just U.S. citizens, but residents, entities like corporations, partnerships, LLCs, trusts, if they have a financial interest in or signature authority or other authority over a foreign financial account. Now, the filing is triggered if the aggregate values of such accounts exceed $10,000 at any time during the calendar year. It's calendar year reporting. What is a reportable account? For FinCEN, which by the way is a little bit different than what we have under the asset reporting on the 1040, so you have to realize those have overlap, but it's not identical, right? In this case, for FinCEN, you're looking at bank accounts, security accounts, annuities, and insurance that have a cash value, mutual funds that are located outside the U.S., which includes territories, right? So if you have these accounts in the U.S. Virgin Islands, you have these accounts in Puerto Rico, you have these accounts in Guam, it's still in there. Now, a financial interest means an owner or of record or a holder of legal title, and a signature authority means a power to control dispositions of funds via direct communication with financial institution. That's, you can sign a check, guys. You can get online and transfer funds without being a scammer that, tricked them and got the numbers. We're talking about somebody who legitimately can do that. Those are cases where you have to be reporting, right? Even if you don't own the account, if you can cause funds come out of the account, you can transfer funds, you got to report it, even if it's not owned by you. Now, this report must be filed electronically. A number of years ago, we lost the ability to do FinCEN reports on paper, right? Cannot be done. It is officially due on April 15th of the year following the reporting year, but FinCEN a number of years ago, when that April 15th date was put into the law, simply gave automatic extensions of 6 months to everybody. So technically it's still due April 15th, and the law says they could provide you with an extension, unlike the IRS on the 4868 that is saying, no, you still got to send that in, right? This follows more what I call the California rule, which is, just, where we don't, a piece of paper does us no good. Why do we care about the piece of paper? It's going to give you the extension. Okay. You are required to maintain specific records, the account name, number, bank details, and maximum value for 5 years. This is outside the standard tax statutes of 3. So this is a 5-year statute that you have to be able to have that information. And non-compliance, if you have non-willful failure, okay, that means you didn't intentionally not file it. You might not have been aware of the requirement. There may have been various things, but there still is a penalty of $10,000 per unfiled report adjusted for inflation, unless you can show reasonable cause. Now, a couple of years ago, we discovered that is, per report, not per account. The Fifth Circuit a number of years ago had held it was per account. The Ninth Circuit said, no, it's per report, the $10,000. And the Supreme Court agreed with the Ninth Circuit. The penalties are on a per report basis, not a per account basis. So that was cleared up. If some of you remember that old Fifth Circuit case, Supreme Court overturned that. However, there are criminal penalties. Fines of up to $10,000 or $250,000 and or 5 years imprisonment, depending upon the violation. Did you knowingly follow a false FBAR? Did you fail to file or retain records? All of those things. And a person can be subject to both civil and criminal penalties for the same violation. So, and again, willful failure, I skipped over that. That's greater of $100,000, which is adjusted upwards for inflation each year, or 50% of the account balance if you willfully fail to file. And it's very easy to be found to have willfully failed to file. Generally, it's good enough to have simply, said, no, I don't have the accounts on Schedule B. That's considered willful, even if the client says, well, I didn't notice that. I never looked at that. Yes, guys, not a defense. Multiple times, taxpayers who have tried to use that, well, I don't read the return. No, guys, there is an obligation on the taxpayer to read the return regardless of, the fact they hired a paid preparer. They're supposed to read the return because the courts have said, if you read that, you should immediately said, wait, I have the ability to sign on my, let's say, my mother's account in Italy, or I have an account in Japan, right? In essence, I should know that, right? In essence, that's not exactly something that's difficult to figure out. That likely, hey, why did you answer that? No, would be the question to your preparer. That does show willfulness. Okay. Now, Circular 230 governs practice, as we know, for CPAs, EAs, attorneys. And practice is, in current 230, broadly defined, including preparing and filing documents, rendering written advice, and representing clients. Now, under Section 1035 competence, you must possess the necessary competence to practice before the IRS. And OPR takes the position that this requires a baseline knowledge of FBAR requirements and the ability to supplement that knowledge as necessary. So everybody should be aware of the FBAR. Now, I know you might say, and I'd kind of say, the case law may very well suggest that this is outside of OPR's ability to push. If you're just preparing returns, this isn't really something they can regulate, but it doesn't matter. In a civil case, I guarantee you that the attorney for the plaintiff who's suing you for paying all these penalties they got nailed with is going to be coming down hard on the fact that, look, according to OPR, you were supposed to know about this. A competent CPA, a competent EA, a competent attorney in tax should know about this, right? That's a baseline requirement. And if you don't, then that's malpractice. Be it. They also say under the diligence provisions of 10.22a, which now I really wonder up on whether this one's valid. But again, I'm less worried about OPR than I am about the civil case. I think in the civil case, you're going to have trouble with this. CPAs and EAs preparing return have explicit duty to inquire of clients with sufficient detail for correct responses to foreign account questions. And more to the point, if you're a CPA, remember, under the statements on standards for tax services, remember a little bit about answering questions on the return? Yeah, that imposes on you the duty to inquire. So if you're a CPA, I don't care whether OPR has the right to do this or not. According to the professional standards that probably are applied to you by your state board of accountancy, you're supposed to, in essence, because that question is there, you're supposed to make the inquiries, just like you're supposed to understand the digital asset rules and what that question means on did they acquire digital assets, dispose of, etc. You got to know that and make inquiries to get the right answer on that. That is imposed by professional standards. And EAs, I know an EA who does believe that even with that case that was brought by a CPA, that probably the OPR standards like this do apply to EAs, because remember, EAs are licensed by the IRS to meet certain standards that allow them to practice before the IRS, unlike attorneys and CPAs that essentially get in based on their state licensing. So yeah, it's a little weirder there. And attorneys, it'll probably just be tough. I hope, if you're preparing returns, it's going to be tough to say that your standards are lower than those of the others. So yeah, it's not going to sell well. I'm just going to say. We also have section 10.34D and 10.21 for your knowledge of, paying attention to what you see and reliance on client information. Generally, and this is true under the SSTSs, it's true here, you can rely on good faith without verification on client information. But if that information appears incorrect, incomplete, or inconsistent, you must make further inquiries. And you have to make sure the client understands the questions you're asking, right? That means to make all appropriate inquiries, if the client suggests potential FBAR reporting. And, Karen Hawkins' view back in the day was, if you know the client has relatives, like, their parents are living in, or let's say citizens of and live in Italy, then that's a case of needing to make inquiries, because there's a better than average chance they have this, right, in place. She said that would indicate something. There's a relationship. Any sort of relationship out of the country would suggest that you probably should ask better questions, and you should explain to people what it is. I will say that on FBAR, I have rarely been surprised by the client's answer yes. It's like, you have an account outside the U.S.? Yeah. And then you get the reason for it. And, it can be varied. It could be about a vacation home there. It could be, all kinds of odd reasons that they somehow have this account. So, hey, they now have this account in Sweden. Okay, great. We'll just kind of go back in and go with it. If non-compliance is discovered, you got to inform the clients of their prior non-compliance. And again, ignore OPR if you're a CPA for a second. This is basically the rule on the SSTSs. You got to inform them and potential penalties, what they could do to mitigate the case. And under the SSTSs, and basically under these standards, you're not required to prepare the report. And the client might decide not to do it. But the number one rule, which you'll do, is you can't perpetuate the error on future returns. So if the client's not going to file the FBAR reports, you can't just answer the questions no on Schedule B and continue to do that, because that would be causing it. That'd be actually lying and committing perjury, because those answers aren't no and no. Okay. So the standards for tax returns under 10.3.4, you got to advise clients any potential penalties for positions taken on a return, must inform them of the ability to avoid penalties through adequate disclosure. Again, if you're a CPA, these are standards that are basically duplicated in the SSTSs. So for FBAR, if foreign accounts must be reported on a tax return, a CPA or EA should prepare the return, or should prepare the FBAR return, or advise the client accordingly to get it done. Again, they don't have to hire you to do the FBAR report, but you need to advise them. They need to do one, right? And you may decide you're not competent, willing to do it. So you don't have to offer that service, but you have to advise the client they need to get it done. And the client doesn't have to hire you for that service, even if you do it. You know, you got to advise them of the need to file it, consequences of failing to file one, but you're not obligated to prepare it. They're not obligated to hire you. So conclusion, adherence to these standards is paramount for fulfilling obligations to the client and upholding the integrity of tax administration. Competency, diligence, and proactive advice regarding FBAR are crucial. As I said, given the case law, I'm not as sure this holds against CPAs or attorneys from OPR, but my concern for you guys, for both CPAs and attorneys in this case, is that it doesn't matter. I think you've got, in essence, civil liability if you're not careful here. So that's the issue. Okay, let's go to a BBA partnership audit case. This is the JM Assets LP versus Commissioner. And how the IRS fouled up the statute in this case. Well, they fouled up the regs. So don't think they're firing anybody, on the exam for fouling up the statute. But they might have some problems with, the regulation, because this is a case where, and why it is a reported case, JM Assets LP versus Commissioner 165 TC number 1. This is a case where the tax court is going to overturn the IRS's regulations, a specific IRS regulation on the statute of limitation under the Bipartisan Budget Act, right? So this is for final partnership adjustments under the BBA audit procedures. And it also is an early case where the tax court uses Loper Bright Enterprises versus Raimondo, the U.S. Supreme Court decision from last year, uses those standards and finds a regulation is wanting under those standards. Actually, the court finds this regulation would have been wanting under any standards, right? We'll get back to that simple aspect. So JM Assets LP is limited partnership, and it filed its 2018 1065, reported real property dispositions as installment sales on 6252. The IRS examined the return and issued a notice of proposed partnership adjustment, NOPPA, on June 2nd, 2022. And they proposed an increase in the Section 1231 gain reported by the partnership. On February 14, 2023, 250 days after that notice of proposed partnership adjustment was, received by the partnership or issued by the IRS, JM Assets submitted Form 8980 partnership request for modification of imputed underpayments. Remember, in a BBA audit, the IRS comes up with their adjustments, assuming that they are, they're going, in essence, assuming they're, underpayment style adjustments that'd be tax due. Then, they submit that, and they submit essentially the proposed bill. You have 270 days to come up with adjustments if you wish to. You can do the push out. That's a much shorter term. You have to do that 60 days from the time this comes out, but you have 270 days under which you can propose modifications. For instance, they're going to initially do everything at the tax rates at all partners or individuals and assign everything at 39.6. But if in fact a 30% partner is a C Corp, you can do this, Form 8980 request for modification and get the amount being allocated to that partner down to 21% by providing the specified information with the Form 8980. And with this, they did not submit Form 8981, a waiver of the modification period. Now, here's where things get involved. The IRS approved the modifications but issued a notice of final partnership adjustment on December 1st, 2023. What's going to be important here is when the statute began to run on how long the IRS had to issue a notice of final partnership adjustment. Now, JM Assets said December 1st of 2023 is too late, IRS. You missed your date. Okay. Under Internal Revenue Code section 6235A2, okay, no adjustment can be proposed by the IRS after 270 days after the date on which everything required to be submitted is so submitted by the taxpayer for a modification request. Now, in Regulation 301-6235-1B2, They defined this limitation as being the earlier of the end of the 270-day window from the notice of, the proposed adjustment, or from the day a waiver is submitted, right? Now, J.M. Assets argue this exceeded the statutory authority. They're saying the day they submitted everything, especially because the IRS never requests any additional information. The IRS had 270 days from the day they submitted their request for adjustments to issue their actual adjustments. Okay. Now, the court cited Loper Bright Enterprises versus Raimondo, last year's Supreme Court case, that emphasized that the courts must exercise independent judgment on agency authority. And Loper Bright takes the position that statutes must have a single best meaning that is fixed at enactment. We can argue whether that's realistic, etc. We can argue various parts about it, but nevertheless, that is the Supreme Court's holding. And in this case, it's not going to be a tough call per the tax court. Now, substantial omission of income section 6235C2 and 6501E1 Cap A, that extends limitation period to 6 years if the omission is in excess of 25% or greater of the gross income. But under a clue test that was found in the Colony versus Commissioner case, there is no omission as long as the return provides a clue to the omitted item by adequately disclosing its nature and amount. Okay, so the IRS is trying to get out of this, saying we're on time by 2 rules. Number one, we're within the 278-day window under the reg. And number two, that there was a substantial omission of income, right? And so because of that, it's a 6-year statute rather than a 3-year statute, right? Or in this case, so there's extra time to go back and fix it even. Now, what was the timeliness of the final partnership adjustment? The court said the code directly conflicts with the regulation, right? 6235A2 says very clearly that once everything's submitted, the 270-day period starts running on the IRS. Now, the Treasury regulation attempts to buy the IRS additional time. But JMS has submitted everything required on February 14th, 2023. The IRS does not claim that they needed any other piece of information besides what they were given on Valentine's Day in 23 to basically issue this. That 270-day period from February 14th expired on November the 11th, but because that fell on a weekend, it would be extended to Monday, November 13th. Well, that's going to be essentially 18 days before the IRS finally issued their FPA. Tax court said, IRS, you missed the date. The regulation that you wrote is contrary to the code. And gang, code beats reg, right? Simple rule here. If the code is, basically, in this case, the court said, look, the code doesn't allow for any other interpretation. If the language of the code is clear, we're done, right? Case I mentioned before, the Germain case multiple times, we're done. Game's over. IRS, you're rigged attempts to buy time, but you're not Congress. Congress said it was 270 days from the date that everything required was submitted. And you missed the date. Okay. Well, what about substantial omission of income? Well, the court said no. I mean, the fight was over the installment reporting, etc. And they said the chance that there could be an underreporting of income, the basic thing at question here, that income was adequately disclosed in 62452, which provided detailed information about the property sales and the installment income. The alleged omission was the increase in the 1231 gain, not a failure to report the income, right? But remember, an installment sale would delay the reporting of net income, but the gross income was already there. Understanding gross income by misstating cost and basis is not an omission as long as adequate disclosure provides a clue. The commissioner's argument was supported neither by the facts nor the law, and there's no point, because the IRS was asked to go back and amend their pleadings when they began to realize that the court didn't seem to be leaning their direction on the reg. They said there's no reason to go back and let you amend your pleadings and argue about this because it's futile, right? Based on what we have in front of us right now, regardless of what you could bring us, you're not going to carry the substantial, omission of income side. So the court granted the partnership's motion for summary judgment. The final partnership adjustment was simply untimely. IRS out of luck, won't get the tax. And they denied all of the IRS's motions, including the attempt to assert a substantial omission. Remember, Treasury regs cannot contradict the plain text of the code. Now, remember, it's plain text. Not your hope that it's plain. We got to be able to stand back and say, could a reasonable person read this text and come to any other conclusion about how to read it? And many times Congress is not that clear. So, there's a lot of code that doesn't have plain text right off, and then we get into, more complicated statutory interpretation issues. But in this case, it was darn simple. 270 days after the last item submitted, the last things needed submitted. So we know that date, and it's not the date you're trying to use, IRS, right? Importance of timing, you got to watch those clocks. 270-day clocks first runs on you as a taxpayer to make your proposed adjustments to the assessment. And then the IRS has 270 days after that. And, keep your eye on those numbers, keep your eye on those dates. Obviously, somebody handling the audit, advising the taxpayer, knew about the 278-day rule and said, hey, we're outside the scope of that, guys. Not going to work. It's also important, especially with things like installment sale, adequate disclosure is key. If the IRS could have shown that they hadn't adequately disclosed the nature of the situation, they could have been found to have a substantial omission of income on the return, and that could have opened up the 6-year statute. I know a lot of people like to do the minimalist reporting, but there's a risk to minimalist reporting on the return. Yes, we're not volunteering that to the IRS, but not volunteering it, take a look at what you're not volunteering and make sure this could not change what would be a 3-year statute into a 6-year one. Because especially, I remember as Burgess Raby stated years ago at a conference, many times the best place to hide something from the IRS is on a tax return. Right, because they don't seem to read anything on that. But the courts do. And so the court's going to hold the IRS to you read that. No, they didn't. Remember, though, it's the same thing as that client with the FBAR. Well, I didn't read Schedule B. IRS, tough luck, you didn't read it. You gave people the forms. You asked them to submit stuff. You probably need to actually read that stuff. Let's be clear here. And remember, post-Loper-Bright, the courts are going to reinforce their independent judgment, reviewing whether agency regulations remain within their statutory authority. My own take on this case is, I think this case lost pre-Loper-Bright. I don't think you needed Loper-Bright, because I don't think it passed the Chevron test. Remember, for Chevron, there first had to be ambiguity. And ultimately, this statute didn't have it. So I think it would have failed under Chevron. But it clearly fails under Loper-Bright. The best interpretation of the statute is, if the statute is not ambiguous, the only interpretation the language allows. Okay. Let's go into a TEFRA audit now, just for fun, and a really quirky result here. This is the case of Moxon Corporation versus Commissioner, a partner in a partnership, right? So this was filed the same day, July 2nd, 165 TC number 2. It's the assessment and collectability of partnership level penalties, but I will warn you, this was under the TEFRA rules. We'd have to go separately to see if it's a belief that the BBA language changed this. I'm thinking it probably doesn't, but it could. It distinguishes the treatment of the underlying tax deficiencies and related penalties, especially when procedural errors lead to the abatement of the tax. Okay. Now, this corporation was a partnership in AD Global FX Fund, LLC. AD Global engaged in the transactions generated purported losses, which the IRS disallowed. And there was a 40% gross valuation misstatement penalty, 6662H, assessed at the partnership level. Now, the IRS mailed notices, statutory notice of deficiency, SNODs, right, to Moxon for 1999 and 2000, determining deficiency and penalties. Crucially, these notices were sent to an incorrect address. That's invalid. They have to send it to the last known address. The address they sent it to was not the last known address of Moxon Corporation. During a collection due process hearing, the appeals officer, one thing the appeals officer has to do in a collection due process hearing is go back and review the record to make sure that all the I's were dotted and T's were crossed. And the appeals officer discovered, wait a minute, this didn't go to the right address, right? Those deficiencies were invalid. And so the appeals officer basically walks in and says, yep, those are abated. Since the tax due on this is totally abated because the notice of deficiencies didn't get sent to the right address. However, the appeals officer concluded that the penalties in this case, per the law, were not subject to the deficiency procedures. Thus, they would not be abated because they could still apply. And that would be true even though you'd never pay the tax upon which the penalties would be based. That doesn't sound right. Well, we're going to discover that the appeals officer is held by the court to be right. Now, issue number one, do deficiency procedures apply to penalties? Remember, the tax is not a question here. Everybody agrees the tax isn't due. The IRS screwed that up, right? Well, Internal Revenue Code section 6230A2AI under TEFRA exempts penalties, additions to tax, additional amounts related to adjustments to partnership items from deficiency proceedings. Okay. Now, the taxpayer, the corporation, argued the penalties should be subject to deficiency procedure, attempting to distinguish deficiency proceedings from deficiency procedures. And they used Loper-Bright to try to challenge reliance on the regulations, saying, hey, the cases the IRS is relying on, they're all decided pre-Loper-Bright. Hey, that means the reg's not valid, and that means we win. Okay. And I've seen a number of different cases and different filings with courts that seem to just say, hey, case was decided pre-Loper-Bright. By definition, that means we win. As this court will point out, the Supreme Court specifically said that's not what it means. It means you might win, but you got to litigate the matter, right? And you got to be able to show me why you win. The second was, what if you abate the assessment, you abate the tax due to this screw up on which the penalty would apply, can the penalty still be collected even though the tax can't be, right? The taxpayer argues the underlying tax was abated, the tax imposed for calculating the penalty became zero. There was no basis for the penalty. And they also said tax imposed requires collectability of the tax. If the IRS can't collect the tax, it's not a tax imposed. Therefore, since the penalty is on tax imposed, we basically, there are, 40% of zero is zero. Okay. Now, on deficiency procedures and penalties, the court reaffirmed the longstanding precedent. Penalties related to partnership items are not subject to deficiency procedures. Such penalties may be directly assessed as a computational adjustment, right? The fact the IRS put those deficiencies in the notice of deficiency or assessing them concurrently at taxes is irrelevant to whether deficiency procedures apply. They don't. The fact the IRS put it on notice of deficiency does not mean that the procedures apply to those, right? Loper-Bright did not overturn prior rulings based on Chevron deference. The holding that proper, that partnership penalties are not subject to deficiency procedures remains valid, even if the assessment is barred. That is a holding of the court, right? Loper-Bright, as I said, simply kind of said, we could reconsider it, right? We didn't have to give deference to the IRS, but the court can still find the IRS reg is the proper and best interpretation of the law. The court also, and this is actually why it was a reported decision, because this part had never been decided before. The argument that, hey, wait, they can't collect any of the tax, don't they get out of the penalty? That had never been decided before, so now the court moves on to that. Tax imposed in 6064A refers to the correct amount of tax required to be shown on return. It never mentions the IRS's ability to assess or collect it. Remember, the statute of limitation bars the IRS from collecting the tax. It doesn't say there was no tax. Right? The tax liability can exist even if the IRS cannot collect it. They're barred from assessing it or collecting it or keeping the money if you send it to them, which they are in this case. The basic formula for underpayment is correct tax, not correct tax the IRS can collect, but correct tax, legitimately determined to be correct tax minus reported tax equals the underpayment. And the doctrine of set-off supports this. The tax liability can reduce an overpayment even if the assessment is barred, right? Let's say the tax was overpaid, right? In that, in let's say in a closed year, well, because you had withholdings, they could reduce that overpayment, right? They're not giving you a refund on the overpayment. You may have heard about that sometimes before. You go back, you ask for a refund of tax from a prior year. IRS doesn't get around to, coming back. They basically can offset that still, because even though the refund, they can offset. There's an overpayment they could offset by showing additional taxes due. They could not have directly assessed the tax. So they go back, you had gotten a refund of taxes from an amended return from, now it's 3.5 years ago beyond the statute, when you had when the refund, when the year applies, but you'd only gotten that refund within the last 2 years, you'd applied for it. Yeah, they go back, find the tax, there's additional tax due for that year, and they can then collect back some or all of your refund. It works. So the tax court granted the IRS's motion for partial summary judgment, ruling the penalties were properly assessed and collectible, despite the fact the underlying tax was abated due to procedural error. So if Moxon is going to get around this, right, they would have to be able to defeat the actual tax, that the tax is not the proper amount. Okay. Now, like we said, partnership level penalties are distinct, right? Penalties earned at the partnership level, TEFRA, and probably BBA, have separate assessment and collection rules for individual liabilities. Procedural errors on tax do not negate the penalty. An IRS error that invalidates the assessment collection of underlying liability, incorrect address on the statute or notice of deficiency, does not automatically invalidate related partnership level penalties. And the calculation of tax imposed for penalties doesn't care whether the IRS can collect the money or not. There's no question they can't here, but that does not matter. So taxpayers challenging partnership level penalties typically must do so via a refund action or a CDP case to raise partner level defenses, not through prepayment tax court deficiency jurisdictions. Right? That's how you challenge the penalty. So what the taxpayer would need to do is pay the penalty and then sue in district court to challenge the penalty. Okay, next up, let's talk about fraud penalties. Actually, our last case this week. This is Beleiu versus Commissioner, the accountant. No, not Christian Wolf, but somebody else here. This is Beleiu versus Commissioner. Tax court ran decision 2025-70. Decision came down July 2nd. This is the standard for civil fraud penalties, which is a fairly high standard. But this accountant was very helpful to the IRS in getting civil fraud penalties applied against her. Interestingly enough, they did not apply against her husband, who actually had the business in question. The problem was she was an accountant, and not just your standard graduate with a bachelor's in accounting, who might have, never used accounting again after graduating. No, we're talking about somebody here who had an MBA with an emphasis in accounting and had a well-paid full-time job as a financial analyst. So what this showcases how circumstances, evidence, and especially her financial background and her lack of cooperation can essentially make the case for a fraud finding. Okay. Now, the petitioners here, the Beleius, filed joint returns for 2012 through 2015. Mrs. Beleiu, she had accounting degrees, bachelor's, and she had the undergrad, and she had the master's, the MBA with accounting emphasis, and she had long experience as a financial analyst, was the record keeper for Remtrix LLC and iTrainX Consulting Groups, and prepared the tax return. Remtrix income was reported on Schedule C. By the way, both of these were owned by her husband, right? iTrainX income was not reported. Now, during the exam, the IRS agent assigned to it, O'Hare, found some significant issues. She found gross income was substantially underreported for Remtrix. In 2013, in essence, in this case, Naomi Beleiu, the person who's the one we're worried about here, she prepared a 1040 showing $38,946 of gross income versus $334,064 of blanks deposits into the Remtrix account. There are a few bucks there that need to be explained. She initially claimed that iTrainX was dormant, but after the IRS got some subpoenas and went to the bank and got all records related to them, discovered that, in essence, there were significant receipts for iTrainX in their bank accounts, $38,600 in 2013, $71,250 in 2014. Mrs. Beleiu did not, Naomi, provided incomplete bank statements when records were requested, and claimed she had no contemporaneous records, that she just, prepared the tax return every year by going through the bank statements. Now, that might have been an okay thing for somebody who, let's say, had no training in accounting. Maybe you have a PhD in English literature, but you could still be that you wouldn't understand anything about accounting, and you might think just going through the bank statements was fine, or something like that. You might think not having current records is fine. But this particular person, she had not only an undergraduate degree in accounting, but a graduate degree with emphasis in accounting. She worked as a financial analyst, which is going to get even funnier here in a second, considering what she claims she didn't understand. It's difficult to say that she didn't reasonably know that she probably needed better records than simply going and grabbing bank statements and throwing things together at the end of the year, that was going to be there. There also were significant cash dealings, which make it a lot easier to hide things when you do that. They had agreed to the tax deficiency. The IRS conceded the 2015 fraud penalties, and all fraud penalties for Mr. Beleiu, who was the owner of the businesses. The issue, though, was whether she was liable for civil fraud. Because, see, he was the person who had no accounting knowledge, no understanding, didn't know what should be there. And his wife had training, and she was a financial analyst. I mean, okay, he relied on her. So it's like, now she's the one trying to defend why she shouldn't be held eligible for fraud. Okay, he won the I'm not smart enough to know how to do this. Okay, he got out from ignorance. Ignorance can be bliss in a case like this. But she's going to have a tough time selling it. And as we're going to discover, she doesn't. Okay, what's the legal framework? Under civil fraud penalty under 663A, 75% of the underpayment it would be attributable to fraud is charged. So if you have a $100,000 underpayment of tax, $75,000 penalty on top of $100,000, right? Now, the IRS does have the burden of proof in a fraud case. They have to prove fraud not just by a preponderance of evidence, but by clear and convincing evidence. There's an underpayment of tax for each year, and at least some portion of the underpayment was due to fraud, and what that is. Okay? Now, once the IRS shows any part of the underpayment is due to fraud, the burden shifts. The entire underpayment is treated as due to fraud unless the taxpayer now can prove otherwise. And as you might guess, the taxpayer, if you're just relying on their testimony at this point, and the court's already decided the IRS has proven fraud, you're probably not going to be treated as the most believable witness ever. We discover that. Now, fraud's definition is intentional wrongdoing designed to evade tax. that is believed to be owing. That's the tax definition of fraud. Okay. Direct proof rarely happens. Rarely do we have this kind of, direct proof. Taxpayer rarely says, "I am committing fraud." Right? I'm sitting down here and saying, "I believe I owe $100,000, but I'm going to do all this odd stuff fraudulently to keep the IRS." That's not ever going to be found. Rather, you're going to find circumstantial evidence that provides what the courts refer to as the badges of fraud. And that's not just in tax cases. We have badges of fraud in virtually any fraud case, right? The taxpayer, its entire course of conduct infers intent. It's going to look at her pattern of behavior with regard to all of this, and then make our call as to whether she was engaging in fraud. That is, intentionally doing wrong to evade a tax that she believed was owing, that she knew she owed tax, and she was she was basically hiding things. Now, some of the badges of fraud, let's see, these are ones that for taxes we have. If you are understating your income, right? If you are keeping inadequate records is a badge of fraud because that helps cover up the fraud, right? Implausible or inconsistent explanations offered by the taxpayer is considered one of the indicators that they are engaging in fraud. If they are concealing income or assets, that is a badge of fraud. If they fail to cooperate in the exam, one reason you fail to cooperate is fraud, right? If they supply incomplete or misleading information, they try to edit what goes to the IRS, that could be a problem. If the testimony is just wildly unbelievable and incredible, if they filed false documents, and if the taxpayer deals in cash. Now, the taxpayer's education and sophistication is considered in evaluating badges of fraud. Remember, her husband, they didn't move forward with because they didn't think they could carry the case against him. But she had all this training. And I think, what I call, I kind of refer to the old Supreme Court case, the cheek defense, where you could get out of a criminal conviction, for tax evasion, if you could prove you were stupid enough, right? You didn't have criminal intent because you were stupid enough that you actually thought that the tax protest or argument you were using was a valid one because you're just an idiot. Now, I always like to point out to people that John Cheek on retrial didn't get the cheek defense to work, but that's it. But her husband did get a cheek defense here against civil fraud now. Now, again, we looked at supervisory approval. That was timely obtained. It was stipulated as timely secured, so that's not an issue there. Well, you want to lose, you might as well lose big. The tax court found that all relevant badges of fraud weighed in favor of finding fraud for her. Understating income. And she knew it was understated. Dramatically underreported Remtrix income, only 5% was reported for 2012. And her claim that she was distracted and had family issues, etc., simply is not credible given how short. You could be distracted and miss $5,000, of $5,000 of 250,000. That maybe distraction could get that okay, but you can't really be distracted and miss $245,000 and do it consistently. That just doesn't make sense. Inadequate records despite her accounting degrees. She failed to keep contemporaneous records. She rather relied on piles of paperwork, that she just threw things together with at the end of the year. She gave implausible and inconsistent explanations. Her claim that she confused net and gross income, 2 accounting degrees as a financial analyst, and she claims she doesn't understand the difference between net and gross income. Well, assuming her accounting degrees didn't come from, something you got by sending in old cereal box tops. We used to do that. Those who are younger have no idea what my reference was to. Anyway, essentially, no, she couldn't be this stupid. And one of the problems is most often she doesn't impress the court as being this stupid, which makes it even more implausible. They're saying they find it unbelievable, right? given her background, just didn't make sense. She also double counted deductions. That takes no expertise. You can't claim the same deduction twice. She concealed income, assets, and items. She repeatedly failed to provide all bank statements, and she actually just concealed iTrain X's existence and income until the IRS uncovered them by basically going to the bank and supplying a subpoena for all records that they had for accounts they had, and it came up. And she failed to cooperate. She was consistently neither forthright nor forthcoming during the examination, and she actively misled the agent regarding iTrain X's status. She lied. Bad news, right? The real question becomes, why in the world did they go to court? Well, this has been the Current Federal Tax Developments for the week of July 7, 2025. Current Federal Tax Developments are brought to you by your state society of CPAs. Be sure to check in with us next week. We'll see what's going on. Keep your eye out. Some of these state societies, I will be doing an update on the new tax bill, which again is going to be long, involved, and messy. Longer than we have with these weekly things to be able to do in detail. So we'll go ahead and work with that. We'll talk about that. I do that. I think I'm also doing it for AFIT at the end of the month. Arizona Forum for Improvement of Taxation, which is a odd cooperative group of the Arizona Society of CPAs, the Arizona Bar Association, the Arizona Enrolled Agents Association, IRS Department of Revenue. Kind of interesting, although the IRS apparently can't send anybody now to go talk, but that's a different issue that we've got there. So we are looking for that. If you have any questions, and I will probably be looking at and making some comments on the whole issue of, the One Big Beautiful Bill Act as I get deeper into it. On there, I'll be, on the websites for or basically for the Connect sites for the state societies for Arizona, New Jersey, Idaho, Illinois, Minnesota, Washington. So keep your eyes out there. Keep your eyes up for what's going on. Otherwise, we will, kind of just keep going here. I will otherwise see you guys back here next week for more current federal tax developments.